please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Rahul Singh, managing partner at Ampersand Capital, joins in to discuss the fundamentals of the market. Rahul, hi, thank you very much for joining in. So what's your sense now? How much of a risk is this entire trade tariff talk, which is emerging from the US and China? And do you think it's probably going to risk us getting to all-time highs?
Well, I think what we are seeing in the market is two different things. One is obviously that the global risks and the domestic risks, primarily on account of rates and politics, is very much there. It's probably going to be there for the remainder of the year. Having said that, I think the markets are holding up because we've had two bad months in May and June, especially for mid-cap. So we are seeing some kind of reversion of the valuation gap which had opened up between the mid caps and large caps. But that's just is just a technical adjustment. I think we could continue to see some of that, which will give us probably a false impression that the risks are behind. But I think the risks are going to remain in this year, in the entire year, arising from two things. It's just not the global trade war, but also the outcome of the interest rate hikes globally, which we are seeing, I mean, especially in US, and the fact that that could start to have an impact on the kind of slowdown it creates for the global growth. Because a lot of things are hinging on global growth, and in addition to that, the trade war risk is there. So our sense is that from an investment perspective, these risks are very much there. On top of it, you start to see layers of different sectors outperforming and underperforming in various stages. So I think that's where these markets are in a state of flux right now.
Okay, there is some flashes at the bottom of the screen. This is the Assam finance minister saying that the group of ministers will take a final call on whether a sugar cess is required or not today, later today. Okay, that is what is being talked about right now. GST Council may discuss sugar cess in the July 21st meeting. Support, including natural gas, jet fuel under GST, need collective decision. I mean, so this is now being talked about and discussed whether, I mean, you can include petrol and diesel is, of course, is difficult, but whether gas and ATF, etc., can be brought under the ambit of the GST before that. So those things also will be discussed. The group of ministers to submit final recommendations to GST Council before the 21st meeting, July 21st meeting. Scope of GST rate reduction on some items following e-way bill launch. These are all comments coming from the Assam finance minister at this stage. Rahul, so what is you fleshed out the global worries, etc. I mean, the trade war bit. So how does that affect your view here as far as the market in India is concerned? And of course, I mean, there are other elements, local elements as well, politics being a dominant one this year and the next one.
Well, a couple of things as an outcome of what I just said. One is that, cyclicals as a sector, whether it's commodities or whether it's the huge capex cycle which everyone is counting on, we need to be much more cautious on that, whether it's the domestic public capex or the private capex or the demand for global commodities. We need to be slightly more cautious on that from a portfolio perspective. And we have very low weightage on some of those sectors. We have been reducing weightage in our portfolio of the AIF which we have in these sectors. Predominantly, one would have to bet on consumption and IT as a percentage. If I had X percentage of my portfolio 1 year back in these two sectors, one would need to be looking at higher numbers in these two segments. So for example, consumption is now accounting for 30% of our portfolio. Similarly, IT services, despite the fact that technically speaking, the global slowdown could impact the demand for IT services as well. But what we are seeing really is for the Indian IT services companies and also the mid-tier IT services companies that there is a the wave of deal wins which they are getting, and also the enterprise spending globally and in US is improving, as we saw in the TCS results as well yesterday. So I think there are enough headwinds for IT services, including the currency tailwind in terms of weak INR, to support our thesis in that. And that and consumption obviously would have to be the two pillars for the portfolio, for any investment portfolio for this year.
Would you be of the opinion that IT is a better way to play the export theme into the US as opposed to pharmaceuticals?
Yes, definitely. I think in pharma we've seen some stability in terms of the price declines reducing, but there are still price declines happening, not at the same pace as we saw in 2017 in generic drugs, but still happening. And there is a pipeline of new products and new approvals which are around the corner, but the earnings from that is probably FY20, FY21 or beyond. Whereas in IT services, what we have is the near-term earnings momentum, and also the valuations even after the run-up are much more reasonable compared to what we have in pharma, and in terms of the cash flow generation, the dividend yields, all those things. If you look at, especially in a market environment like that, there are still a lot of things, a lot of tick marks you can make for IT as against pharma.
Where do financials lie in that matrix?
Yes, financials, I think NBFCs and HFCs would, we would stay away from there, because the interest rate environment is definitely not cooling off in a hurry. Domestically and globally. What we like is the private sector banks which are gaining market share, some at the expense of PSU banks, and some at the with the very fact that there are some good bottom up ideas in private banks itself, where they are gaining market share, gaining CASA, and growing at above industry rate. When I say industry rate, they are not growing at the industry rate of the private sector bank, but they are even outgrowing some of their peers in private sector banks. So I think those are the bottom-up ideas in financials one will have to look at, because thematically there is not too much happening in financials. You need a broad-based rally in NBFCs or in banks, for example. So one will have to be more selective and look at more bottom-up ideas in financials as against IT or consumption.
Rahul, what's your sense in terms of the kind of dichotomy that we're facing in the market as a whole? Because right now we're flirting with all-time highs for the Nifty, but the mid-caps are very far away from those highs that we saw in the month of Jan. What's your approach now? Would you be looking to probably stack up on stocks which are anyway at hefty valuations and stay away from the ones which have corrected significantly?
Well, I think what we have seen is, probably 75% technical and 25% the overvaluation which happened in mid-caps. When I say technical, there are two things which have happened. One, obviously, the wave of FIIs selling in the large caps. Most of the domestic flows which have happened have gone to absorb that selling which has happened in large caps from the FIIs, leaving very little money for mid-caps. To be deployed. In addition to that, we had issues around ASM, we had issues around the reclassification of norms for mid-caps and large caps. So there's been a lot which has happened technically in the mid-cap space. And we think that some of the mid-caps we speak to on a regular basis and we track as part of holdings have displayed a tremendous amount of business outlook optimism. In terms of their order books or in terms of the momentum which they are seeing ground up. So we stay invested in those mid-caps. We're not increasing weightage in mid-caps. Incrementally, we have added more weight on the large caps. But as far as the mid-caps are concerned, I think this divergence is probably overdone, and we'll see some return to normalcy in the next 1 or 2 months.
Okay, Rahul, we're going to leave it on that note. Thanks very much for joining in and